Now, I'm here to talk about senior secured loans and really talking about why I think it still is a very attractive asset class in clearly what we have today, which is a very low interest rate environment. I'll start off by doing a compare and contrast on high yield bonds, which tends to be the better known asset class, against what you get today in the what used to be known as the leverage loan asset class, really more familiar today as the senior secured loans. There's a lot of similarities between the two, but the main differences for us really are the fact that it's a much safer instrument, and actually perversely you're getting much better returns today. So if you look at the difference between them, loans tend to be 7 years in terms of final maturity. High yield bonds anywhere between 5 and 10 tend to be longer dated on average than loans. Clearly loans are a LIBOR plus instrument, so you are not taking any interest rate duration on the loan asset class. High yield bonds are fixed and clearly can have significant credit interest rate duration. Security is really the very significant difference between the two. So loans, you are top of the capital stack. So you get security over everything that the company owns. So that's the plant and equipment, the property, any intangibles of the company. But just as importantly, you get control and share pledges over all of the equity. So if anything happens to go wrong on the company, you can take the company lock, stock and barrel, sell it to the highest bidder, and it's part of the reason that loans have such high recovery rates. High yield bonds are typically unsecured. Most of the time they are behind loans in terms of the capital structure, so there tend to be a loans and then high yield bonds behind them, and high yield bonds don't recover anything unless the loans get repaid in full. So just by their nature of their structure, they're a much safer asset class than high yield, and yet, as I'll come on to, the yields are actually more attractive today in loans than they are in high yield, and then we'll talk about the technicals behind that. The one thing that high yield has going for it that loans don't is call protection. So high yield bonds, when they're issued, tend to have between 3 and 5 years where the company is not allowed to take the bonds out, except for at a significant call premium. Loans do not have call protection, tends to be 6 months on a new issue, and that even then tends to be at 101 of par. So you're not buying loans because of a significant capital appreciation. You're buying loans really because you're getting a very high interest rate relative to the risk, and you are having very low actual downside in terms of if anything happened to go wrong. And then lastly, covenants. So a lot is written in the press about loans and the degradation of standards in terms of documentation in loans, so they're now cov light. What's always kind of surprised me, if you compare it to high yield has never had covenants. And yet people don't write about the terrible covenants that you have in high yield bonds. They tend to write them about loans because the loan market was blessed with covenants. So you still have actually a significant part of the market that has covenants. But our view, and my view has always been in terms of covenant light, that you can price it. That actually if you're getting paid enough of a risk premium, covenants are something that's a nice to have. But ultimately I would rather lend to a good quality company with predictable cash flows and get paid even more for it for not having covenants than actually invest in a company with covenants that we think is a far inferior credit. And I think that's the way the market has gone in the US, and it's the way it started to go in Europe as well. So actually there's now an adverse selection of companies that have covenants in the liquid market tend to be the worst quality companies. Then we look at the value of the two. So having said all that, view is loans should be more attractive than high yield bonds, are safer, so therefore you'd expect them to yield less. This shows you what's happened between the loan and high yield asset class over the last 10 years. And you can see here that today anything below the line means that loans have a high yield, and anything above the line means that bonds have a high yield. And this is at a single B level. So this is taking out the mix effect that you have in the index. This is just single B high yield bonds against single B loans. So a like for like comparison. And yet today you're getting higher spreads in loans despite having security, despite being top of the capital structure. than you are in the high yield bond market. There clearly been periods where post-crisis, because there was no buyer base, actually loans yielded significantly more than high yield, but that was really an anomaly in my view in terms of it just being a CLO and bank market, and it's a much broader market today. And then you had things like the Greek crisis where high yield bonds ended up trading at 300 to 400 basis points more because of fears credit risk, which is a more normal reaction to any kind of market stress, is that high yield has much, much greater downside risk than loans. Yet today we're in a benign credit environment, and yet loans are still yielding more than high yield bonds. So you're not getting paid to take incremental risk today. And so clearly that begs the question, why is that? And if we look at the growth in the market of both loans and high yield, so the dark coloured chart here is the loan market. So clearly the loan market was by far the bigger market prior to the Lehman's crisis. Vast majority of issuers just had loans. High yield was the exception rather than the rule. And then you can see pretty dramatically what's happened post-crisis is that the loan market's actually shrunk and the high yield market is at its record ever size in Europe. And the real drivers behind this are, there's a couple of things that have really driven this. One is regulation. So as a lot of you will be aware, you can't have loans in a UCITS product. It's not a security. TS and UCITS stands for transferable securities, so loans are not allowed within that UCITS framework. So that's meant a lot of the retail money and other money that's come into the market post the crisis was shut out of the loan market. And prior to the crisis, the two biggest buyers of loans, when you see this significant amount in the dark coloured bar here, were banks and CLOs. They were about 90% of the market were banks and CLOs. Banks clearly well publicised problems they had post-Lehman's, weren't buying loans, were a net seller. CLOs took about 3 years to start having any capital formation coming back into the market again in Europe. So there was just no natural buyer base of loans, and hence why high yield came in, took significant market share, sold it really into the retail investor base, and the loan market actually contracted in size. We've started seeing the loan market grow again really because institutional investors who can buy this asset class, so it's just forbidden from retail, institutional investors can buy and within the fund structures or as at separate accounts, have started to realise the value. And so we're now seeing the market grow, and I think actually the loan market will end up taking significant market share back from high yield. But because of those technical imbalances that we've had historically, I think that is the major driver of why high yield bonds are tighter today than loans, despite having significantly greater risk in terms of where they sit in the capital structure. And this really is probably the best illustration of that. So this is the average, this is the S&P data for the average deal done last year in terms of both first lien. This is where senior secured loans sit, so about just under half the capital structure on average from a brand new LBO, so private equity backed business. They've come in, they've put a big equity ticket down, so 48% of the capital structure is pure equity. This red sliver here tends to be high yield bonds or second lien or some other subordinated asset class, and at the top you have loans with all that protection. So today you have about 50% of the enterprise value that the private equity firm has just paid for the business. That has to be lost before you're at risk of losing a single cent as a senior secured lender. So your margin of safety is greater than it's been. If you compared this to a 2007 type graph, that first lien was about 70% of the purchase price that private equity were paying. And yet, despite that, through the crisis, loans still recovered about 80%. So about 80 cents in the euro when they defaulted, loans still recovered that much, only lost 20 cents on average with much worse capital structures. So we think actually the fundamental risk of loans is lower, and yet the returns is much higher today. Page 7, this is Moody's statistics, so it shows you these are ultimate recovery rates, so if you hold a loan through a default, come out the other side with whatever the new instruments are valued at, including equity, what do you actually get back? And this really shows you loans at 80% of par value has been consistent, and there's actually very little variability year on year in loans. It's kind of ranged anywhere between 70 and 90 depending on the year, but very consistent really because they're at the top of the capital structure. If you look down to senior secured bonds and subordinated bonds, which is the high yield bond market, the average is about 45%. So there's a 35% difference in recovery rates between the two, and also vintage makes a huge difference in high yield. So there are years where the average recovery in high yield has been in the single digits, and there's years that it's been closer to 100. So it's much more volatile in terms of recovery rates in high yield, but ultimately through the cycle they recover much less, and again suggests that you should be getting a risk premium for high yield bonds today. Then we come on to the kind of efficient frontier in terms of returns and volatility. So as you can see, the kind of green bar here, so if you look up halfway between 0 and 4%, the green at the top, your European loans, CS Welly, so that's the index Credit Suisse do, measuring returns over the last 20 years now, relative to European high yield, which clearly has had greater returns and much greater volatility. But loans have managed to do this in terms of being a very attractive place on that efficient frontier, despite having a real negative headwind, which is falling interest rates. So loans should actually not do very well when you see significant interest rate cuts, when you have close to zero. They're a floating rate asset class. So they don't, just as I talked about earlier, they don't benefit from interest rate duration. So a huge benefit for all fixed interest, as I'm sure most of you know, has been what's happened to interest rates since Lehman's, and the fact that having interest rate duration was a significant positive for any fixed income portfolio. Loans were on the other side of that trade, and yet because the spreads were so attractive, have still resulted in significantly attractive returns and very low volatility at a time where interest rates were consistently cut. Now, I think you can argue today it's very hard for the ECB to cut a lot further, and probably can't cut from where it is today, so we're pretty much at the floor. But loans really come into their own when you see rising interest rates. So you're already starting to see that in the US. And I think at some point in the next 3 years, it's more likely clearly that you'll start seeing interest rate rises here. But in the meantime, you're still getting paid more than you have for high yield, and you take none of that interest rate duration with the kind of free option of a beneficial effect from any rising interest rates in the future. Then we come on to the search for yield. So again, this is the kind of anomaly I was talking about earlier. These are the indices between the European corporate high yield bond index today, which is yielding just over 4%, and the Credit Suisse loan index, which is yielding just over 5%. So despite having lower volatility, having higher ratings, we are yielding more in loans than you are in high yield bonds. And again, I think that's purely because of the technical reasons. And if you look at that against, clearly where investment grade, everything else, it's such an outlier in terms of risk profile. And to give you some kind of concepts of the maths and why I think this is so mispriced, so the average loan today trades at about 5%. If you think of the recovery rate, so the Moody's recovery rate statistics are you recover 80%, so you lose 20%. The long run default rates on loans, let's call it 4%, it's slightly better than that, but it's over the cycle, it's about 4% per annum. So you're losing about 0.8% per year in terms of actual fundamental credit losses if you hold a portfolio over a cycle. And for that, you're getting paid over 5% in terms of risk spread today. So that relationship between the two makes no sense to us. The worst year on record for European defaults was over 10%, so you lost about 2%. If you do the same maths for high yield is yielding less than the worst year in record for losses. So there's real risk of capital. There really isn't the same risk today in the loan market. We come on to high yield bonds against Syndicated in terms of correlation. And I think the correlation actually is higher today in terms of the last 5 years than it will be going forwards. And I think that's really because you started at very wide credit spreads on both markets. So you see about a 0.8 kind of correlation between the two. So it's not perfectly correlated, but it's clearly directionally been the same. And that's really because credit spreads have been correlated together. But if you go down and you're looking at your portfolios and there's investment grade or you're in the Barclays Global Ag, actually, so you see European loans have pretty much no correlations against the Global Ag. Makes sense. There's no interest rate sensitivity at all in loans. It's a pure credit play today, and has higher kind of correlation with riskier asset classes like equity, clearly directionally the same. You saw that through the European crisis. You clearly saw some of that through Lehman's, but is much dampened in terms of the effect. So as the volatility statistics show, you'll have a much lower actual kind of beta within the fundamental market. So we're earning outsized returns for much lower risk. So market opportunity. So this is kind of more starkly illustrating what I talked about earlier in terms of the loan markets, shrinking and then starting to grow again. Really, as I say, you've displaced, the CLOs have started really printing against. The CLOs are coming back into the market, but still are a much smaller size than they were pre-crisis. The banks have pretty much exited, and I'm sure you're hearing that from the people presenting direct lending strategies as well. It's really not a core asset class for banks anymore. It's very penal in terms of their regulatory capital, and they've been a net seller consistently for the last decade. And really the growth, as I said earlier, that's coming from pension funds, insurance companies starting to invest sometimes for the first time, or making top-ups from investing 2 or 3 years ago when they first dipped their toes into the water. But I think there's a significant amount of interest and potential people coming into the market. And I think ultimately the spreads are far too wide relative to the risk today, and that tends to be solved in the medium term by the markets being more efficient than I think they're pricing that risk today. Then we take a look at where the spreads have been historically. So the question we get a lot is, well, that's all well and good, but clearly there's been significant spread compression. This used to yield a lot more than it does today. Have I missed it? So what we really show here is clearly, you got up to almost a 30% return post-Lehman's. It was totally illogical relative to the risk, and that clearly snapped back very quickly after a year, but remained at very elevated levels because of the selling from both banks and CLOs. This doesn't illustrate it perfectly, but if you actually look at both the 2-year DM, so 2-year DM is 2-year discount margin. So this is the average life of a loan is actually 3 years from inception, and I think for the market as a whole, 2 years is a much better proxy given the maturity profile of loans as a whole. So I think 2 years tends to be more accurate for what your actual returns are. 3 years is what people tend to use in the market, so we show both. But if you actually drew a line between where we are in 2017 and what you saw pre-crisis, we're still at spread levels that you saw where you saw US recession, tech bust in the early 2000s. We are at the same spread as when you saw significant dislocation in the early 2000s, and yet our default rates today are sub 1%. So we're not seeing, there's no credit actual risk that we're seeing in the near term within the portfolios, but we're getting outsized returns. Again, a reason for being in loans today, and the index price is still on average just below 100, having traded significantly above 100 for most of the time from kind of 2004 to 2007. The other side of the equation, clearly we've talked a lot about returns, but it's about what is the risk in terms of loans today. So if we look at the two things I think really should be focused on are what is debt to EBITDA, although I think this is a very imprecise statistic. It's the one the press loves talking about the leverage levels going up, some of the stories about it going back to pre-crisis highs, which actually the data doesn't support. But what you've seen on this is that debt to EBITDA is on average between 4 and 5 times in the European market today. But I think what that really misses is the mix effects that you're seeing in the European market. 90% of the European market is private equity backed today. And if you look at what private equity portfolios have been and what they've been buying post the crisis, it's really been defensive assets. So more utility-like, telecom, healthcare, really because they haven't had a huge amount of confidence in the European economy to date. Clearly, you've had anemic GDP growth across the continent, and that's resulted in private equity firms actually buying less cyclical businesses. Pre-crisis, the real trade was to go for cyclical businesses in the European market. And you saw a significantly higher risk profile, I think, of borrowers in the market pre-crisis at the same leverage levels than buying a kind of telecom or healthcare company today. And the best way really of showing that is the equity contributions. So pre-crisis, you were getting about 30% of a new deal was being put in by the private equity and 70% was debt. And as I talked about earlier, today it's close to 50% of the equity price has actually been put in as physical equity from the private equity firm. So it just shows the multiples they're paying today much higher than they were pre-crisis, but that's because the quality of businesses are much, much better. The cash flow generation of those businesses is much better than you saw in 06, 07. And what we're also seeing, and I think that's also part of the reason you've seen significantly lower volumes in terms of the loan market. Private equity has struggled to find businesses attractively priced with those kind of defensive characteristics, and so you've seen much less supply come into the market. Again, private equity, as you'll be aware, has probably more dry powder than it's ever had in its history now. So I think you're going to see a significant uptick in terms of deals being done, more loans coming to market, and actually a better, a wider choice for investors to come into. So we think the supply is about to get very attractive, and I think that will help keep spreads at wide levels and much wider levels than we think they fundamentally deserve to be. And then one of the last things to really talk about is the benefits of floors. So every new European loan today has a LIBOR or Euribor floor. So that tends to be either at 100 basis points if it's an older deal or a deal that's been coming with US loans as well, or it's at zero which even today has got a significant value, a zero floor given Euribor is minus 40 basis points. So there's a significant pickup in what the value of that floor is today. This shows you the average floor today in the European market is worth about 120 basis points above where Euribor actually is. The red line shows you the US, where you used to have a similar effect. It used to be significantly valuable, a US LIBOR floor. Today actually has no value because LIBOR in the US is above the actual floors. So for a lot of reasons, we prefer Europe to the US. We think there's a significant value still within that European market, and we think that you're getting paid far too much for that risk. And this is just a summary slide, but thank you.
So, any questions? We have a lazy audience, yeah?
That's right.
Or every question is already answered. Ja. Okay, dann nochmal herzlichen Dank. Thank you very much, Zach.